Margin of Safety, Risk-Averse Value Investing Strategies for the Thoughtful Investor by Seth Klarman is a highly regarded investing guide that focuses on value investing principles. The book advocates for a conservative risk-averse approach, emphasizing the importance of buying securities at a significant discount to their intrinsic value to provide a margin of safety. Here's our pick of the top 10 insights from the book. 1. Investing with a margin of safety reduces the risk of significant loss and protects against market miscalculations. Imagine traipsing through a financial jungle where every vine you swing on could be a snake in disguise. Investing without a margin of safety is like trying to tightrope across this jungle blindfolded. Now, let's pull back the blindfold. Enter the concept of investing with a margin of safety, the equivalent of installing guardrails on your tightrope, or better yet, opting for a sturdy, snake-free footbridge. It's the art of buying a dollar bill for merely 50 cents, giving you a cushion plush enough to break the fall of unexpected market acrobatics. By insisting on this discount, you're less likely to have your portfolio nibbled away by the piranhas of poor judgment or sudden economic shifts. It's not about fearing the investment beast, it's about taming it with a comfy financial beanbag. So, do like Klarman suggests, build that buffer and watch the market's peaks and valleys with the serene smile of someone who brought a parachute to a cliff dive. 2. True value investing requires patience, discipline, and a willingness to withstand psychological pressure from the market's herd mentality. Imagine you're at a wild concert where everyone's jumping and frenetically nodding to the beat. Now picture yourself calmly sitting there, earplugs in, coolly reading a book on economics. That's true value investing in a nutshell. It's not an adrenaline-fueled bidding war. It's a Zen garden of financial contemplation. While the market is a frenzied flash mob reacting to every tweet and tremor, the steadfast value investor waits with the patience of a cat at a mouse hole. The discipline needed is akin to resisting the siren call of grandma's calorie-laden apple pie. And as for psychological pressure, it's like keeping a straight face while everyone in your group chat is losing their minds over the latest meme stock. Argout. 3. Diversification, while often touted as a means of risk reduction, can actually lead to mediocre performance if not applied judiciously. Imagine you're at an all-you-can-eat buffet, but instead of piling your plate with that succulent roast beef and lobster tail, you opt for a scoop of everything, including the Jell-O no one's touched since 1973. That's what over-diversification in your investment portfolio can look like, a mediocre feast, with too many filler investments, diluting the potential for succulent returns. Seth Klarman, in his book Margin of Safety, argues for a judicious smorgasbord. It's not about having little bits of everything. It's about carefully selecting those delectable opportunities that truly add value. So, the next time you're tempted by financial Jell-O, remember, quality over quantity can lead to a more satisfying meal and investment portfolio. 4. Market inefficiencies, such as those caused by irrational investor behavior, can be exploited by the astute investor for profit. Imagine a world where everyone loses their marbles over tulips. It happened. Or over cute digital felines in cyberspace. Happening. Now, savvy investors like the ones following Seth Klarman's wisdom in Margin of Safety lick their chops when such irrational exuberance unfolds. Why? Because it's like a garage sale where everyone's fighting over a broken toaster while ignoring the vintage Rolex on the table. Market inefficiencies crop up when people start betting on the financial equivalent of who can gulp down the most ghost peppers. The cool-headed investors step in, ordering a glass of milk or a stable stock, and wait for the spice-induced madness to pass, walking away with profits while others reach for another pepper or a risky investment in tears. It's about recognizing when the crowd's zigging way off course so you can calmly zag to the bank. 5. The best investment opportunities may arise during times of financial distress or when assets are out of favor with the majority of investors. Picture the investment landscape as a swanky soiree where assets are the guests. Sometimes the room fixates on the flashy, dance floor dominating tech stocks, showering them with affection and pricey cocktails. But quietly sulking at the punch bowl, nursing a budget soda, you spot distressed assets, unloved, out of fashion, and perfectly priced for a bet. It's in these wallflower moments where panic and pessimism rule the roost that savvy investors like you strike. With a contrarian twinkle in your eye, you know that downturns craft discount aisles in the market, where the everything must go prices have the potential to transform into everything came back rewards. These diamond in the rough deals may not get the limelight, but they can certainly help your portfolio perform a glorious moonwalk on the return charts. So, keep your eyes peeled and your wits about you. The next bear market bash could be your ticket to the Investment Hall of Fame, or at least a solid return on capital. To sum it up, Margin of Safety by Seth Klarman underscores the importance of adopting a disciplined investment strategy that focuses on risk management through margin of safety and taking advantage of market inefficiencies. The book emphasizes the value of patience and contrarian thinking in the pursuit of superior investment returns, especially in turbulent times when assets are undervalued. Thanks for watching.